Hey everybody, welcome to your weekend review for the week of Monday, January 16th, 2023, and oh, what a week it was. Started off Monday being closed. The bond market was closed on Monday, although we did get a post from our sponsor at WellThatMakesSense.com. This is from the great book Traction by Gino Wickman, where hopefully you've set your goals by now, and then this series will set up the format for being able to accomplish your goals throughout the year, how to have better meetings, how to hit your goals, and how to do a lot of things much more effectively. On Tuesday, the bond market reopened and was down 1/4 point very early. Stocks and bonds lost ground in overseas trading during the overnight session and during the market holiday. There isn't a single obvious motivation for the weakness, but someone had to pick a focus. It would be speculation over upcoming policy from the Bank of Japan. A measure of the New York State manufacturing activity plummeted in January to the lowest level since the early months of the pandemic as new orders and shipments collapsed. New orders dropped nearly 28 points to minus 31.1, also the lowest since May of 2020. This sounds bad, but it's good for inflation, so pick your poison. The Federal Reserve Bank of New York's General Business Conditions Index decreased nearly 22 points to minus 32.9, data showed Tuesday. The reading below zero indicates contraction. The figure was more than twice as weak as the most pessimistic estimate by Bloomberg's survey of economists. On Friday, we also got consumer sentiment as a reminder, so the market was kind of digesting. Consumer sentiment came in at 64.6 on a 60.5 forecast. It was 59.7 previously. 1 year inflation expectations came in at 4 versus 4 previously. 5-year inflation expectations came in at 3 versus 2.9 previously. Last week, we saw the UMBS index gain 0.36% in excess return, giving a helping hand by declining volatility, and the Federal Reserve has floated the idea of downshifting to a 25 basis point focus. Going forward, Fed futures sees a terminal rate of less than 5%, while the June FOMC is a top-up. By the time summer cools into fall, forecasters see the Fed rate cut, because we'll be in a recession. Barry B at MBS Highway predicting an improved Q2 for inflation, predicting inflation moving much lower and a drop in rates, specifically calling for a May 10th improvement, which is a reaction to April CPI, largely due to the numbers being a 12-month average and last year's numbers increasing then, therefore making the year-over-year better. Doesn't make the cost of eggs any cheaper though. PPI and the 20-year auction are coming on Wednesday, and debt ceiling announcement on Thursday. Those are kind of the big events of the week. At the end of the day, we're down 19 basis points at 101.28, which puts us just underneath that range. So it puts us in that very narrow range between 101.71 and 101.01. While the Friday's Treasury announcement that the debt limit will be breached on 119 is concerning, the Treasury will again employ extraordinary measures, air quotes, to keep the government functioning through early June. If the ceiling isn't raised by then, watch out. With the House of Representatives hands and Republican hands, and the White House and Senate both in Democratic, it's exactly the same scenario as 2011, the last time we had a major crisis. That was from econ70.com. Wednesday, the 18th, was a solid open for MBS, being up 33 basis points early. The 10-year was down 14 basis points in the morning. The overnight session started off with the Bank of Japan holding policy steady despite speculation that it would allow a wider band of yields. We got retail sales. Retail sales came in at minus 1.1 on a minus 0.8 forecast. It was minus 1.0 previously. Last month was revised down from 0.6, so it went down from negative 0.6 to negative 1. Core PPI came in at 5.5 on a 5.7 forecast. Inflation at wholesale level 0.5% fell 0.5% month over month, according to PPI. This comes after a 0.4 increase in October and 0.2 in December. The decline is driven primarily by a decrease in energy prices. The index is up 6.2% on a year-over-year basis. Stripping out food and energy and trade services, the index rose 0.1% month over month in January, 4.6% year over year. Overall, it looks like inflation is on its way down. However, it is far from where the Fed wants it to be. Industrial production fell 0.7% in December, and manufacturing production fell 1.3%. Capacity utilization went from 79.4 to 78.8. Again, I have to look at the Atlanta Fed's estimate. I don't see how this data comports with a 4.1 GDP growth. It just doesn't add up. With mortgage rates now at a 4-month low, we saw a healthy pickup in mortgage application data with a 27.9% change week over week. According to the MBA, the 30-year fixed rate decreased 19 basis points to 6.23. And that helped to pick up in both purchase and refinance activity. Home builder sentiment rose slightly in January, according to NAHB Wells Fargo. This is after a string of declines because those guys are just so pessimistic. Weaker domestic data led by retail sales gave a rally a second win in the morning hours, while some Fed speakers pushed back. Others acknowledged the 25 basis point hike reality. 10 years were ultimately able to break and hold below the prevailing range boundary at 3.40, 3.42, ending up at 3.370, which is a pretty decisive break. At the end of the day, we were up 23 basis points at 101.53, which puts us just underneath that 38% Fibonacci retracement line. On the border of possibly, it looks like it did test that today, though it held. So we're in this very narrow range of rates there. We also got news. China's domestic gross product grew 3% in 2022, according to data released yesterday, down from an 8.1% rate in 2021 and below the government's target of 5.5%. It marks the slowest pace since the 1970s as the world's second largest economy struggled under strict COVID-0 policies and a decline in the real estate market. The economy grew 2.9% in the fourth quarter as China relaxed those policies that stunted retail sales and disrupted production. Employment remains a concern with the urban jobless rate at 5.5%. So China's economy is shrinking, which we sell a lot of goods over there. We manufacture a lot of goods over there, but that's also what they're willing to admit. So it's probably way